The S&P 500 is not at all the same index that it was 10, 15, 20, or 30 years ago. It's a very, very different index. So you have to be careful with people that say that the S&P 500 is very overvalued today compared to its historical averages. Comparing today's valuations to the valuations of 20 years ago for the S&P 500 is like comparing apples and oranges. In the early 90s, the tech sector represented roughly 5% of the index. In the 1970s and 1980s, tech was actually less than 5% quite often. As we went on into the 90s, tech got up to about 10% of the index by the mid 90s. And then by the late 90s, it actually surpassed the 10 mark, the 15% mark. And during the tech bubble, it got up almost up to 35% of the index. But we know that this was a bubble and it crashed back down and it stayed at around close to 15% for most of the next decade after the tech bubble until around 2015 when it started really approaching more like 20%. But the tech sector historically has been way below its current weighting. Its current weighting is about 32% strictly speaking, if you look at the statistics. But if you include companies like Google, Tesla, and the other Mag 7 stocks that are not included in the technology index, the tech sector weighting, or what I would call tech plus, is really about 42% of the S&P 500. Today's S&P 500 index effectively has a technology weighting of over 40%. And this is absolutely unprecedented. Again, for many of you watching this video, during your career or during your life as an investor, tech wasn't even 10% of the index. But even after the year 2000, technology was around 15%, sometimes a little higher. What this means is that the S&P 500 index today, with tech being over 40%, is a completely different type of index, and we have to think of it in a different way. Comparing the valuation of an index that has a weighting in tech of 5%, 10%, 15%, 20% versus today's S&P 500 index, which has a weighting of over 40%, it's like comparing apples and oranges. The valuations between the S&P 500 today and the S&P 500 from 20 years ago, it's really just not a comparison. It's not a fair comparison. And so we got to be very careful. And I want to show you how dramatic of an impact this change in the composition of the S&P 500 has had in terms of how it impacts the valuation of the overall index. What we're going to see here is different types of PE ratios for the S&P 500 and for the technology sector. And what we see here right here is that on a trailing gap basis, the S&P 500 has a trailing PE of about 28 times, but tech has trailing PE of 38 times, and the S&P 500 X Tech has 21. Now, if we go over to the operating PE and we look at the forward PE, PEs are actually a lot lower because they're baking in a tremendous amount of growth. Analysts are forecasting a tremendous amount of growth in the next 12 months. Now, we'll just have to see if this growth actually materializes. But the point is that you can actually see here is that the amount of growth that's expected is spectacular. The S&P 500 is currently trading around 21.5, 22 times its forward estimated earnings. Tech is trading around 28 times, which is quite high, but still a lot lower than the 37 trailing on operating. What's interesting here is S&P 500 X technology is trading at 16.8 times. So here is where we really get to the crux of the matter. If technology plus Amazon, Google, and Tesla represented 5% of the index, the way it did up until the mid 90s, then the PE ratio of the S&P 500 on a forward basis would only be 17.3 times its earnings. On a trailing basis, it would be pricey, but not that big of a deal. And on a trailing operating basis, again, the S&P would be a little pricey, but not a really big deal. the change in the PE as a result of the changing composition of the S&P 500 is dramatic. On a trailing operating basis, the PE would have been 30% lower had tech only had a 5% weighting. On a forward operating basis, the S&P would have a PE ratio that's almost 20% lower. Now, we can play with these numbers. Let's go over here and put in 10% and see what it looks like. So obviously these numbers come down a little, but still the impact is very dramatic. The S&P 500 would have a PE that would be 16.6 times lower. Let's move this to 15. Again, the S&P 500 would have a PE ratio that would be 14% lower, 21% lower if you're actually looking at the trailing operating PE ratio. That's why I'm saying that we're really comparing apples to oranges. The S&P 500 with a weight of 41% is just a very, very different index, and that has a tremendous impact. So we got to be careful when we say that the market is expensive. Tech is expensive, but the overall market really isn't all that expensive, even by historical terms. It's a little bit pricey by historical terms, but not anything that's dramatic or very much to be concerned about. What is apparently overvalued, or at least what we need to be concerned about, is the tech plus sector, which seems to be quite overvalued, or at least it's very expensive by historical measures. We also have to be careful. Just because something is expensive and just because the PEs are high doesn't mean they're actually overvalued. We have to really examine the type of assumptions that are going in to those that are assigning PEs that are so high in the tech sector. To summarize, the rest of the market outside of tech isn't really particularly overvalued in historical terms, not something to be particularly concerned with. There's even sectors like the energy sector that are really looking cheap right now, that are just bringing in tremendous amounts of free cash flow and that are sitting there at multiples around 13 times earnings for the sector overall. But if we look at tech, the valuations are high, and those valuations are implying assumptions about the future in terms of returns on incremental capital investment and EPS growth that's going to be resulting from that seem to be quite unrealistic, to say the least. So thanks for joining me today. Make sure to subscribe to my video. And if you're interested, join my free community that I have a link to. And you can also join my Seeking Alpha service, where you can see what it is that I'm doing to actually implement some of the ideas that I talk about in these videos in my portfolios. Thanks.